and welcome. This is Business at 9 and I'm Shibani Gharat. Now, Tata Consultancy Services has announced a strategic partnership with global alternative asset management firm TPG to accelerate the growth of its AI data center business, Hypervault. This collaboration marks a significant step in TCS's AI ambition. Anurag Joshi gets more on this story. Let's go across to him, Anurag. Tell us more about this development, Anurag.
TCS has secured a $1 billion investment from private equity firm TPG to boost its AI data center business. TCS strategic partnership with TPG will boost the growth of the AI data center business called Hypervault. The investment will support Hypervault's GW scale AI-ready infrastructure build, and the partnership is, according to TCS, is a significant milestone in its ambition to become the largest AI-led tech services company. TCS Hypervault will be funded through equity investment from both TPG and TCS and also debt. Both partners combined have committed to invest up to 18,000 crore over the next few years. TPG of this will invest 8,820 crore rupees, that's $1 billion, to have a stake between 27.5% to 49% in Hypervault. And bringing in this investment from TPG as a strategic investment partner will drive returns to the shareholders of TCS, the company said in a statement today. This funding of TPG is through TPG Rise Climate and its Global South initiative. Additionally, TPG is also partnering through its Asia real estate business.
So TCS is indeed betting big on AI. Let's also listen in to what TCS management said post Q2 earning on their future investments in an exclusive conversation with ET Now.
The voluntary separation or separation of employees is not led by AI, but AI is causing a lot of stir or the disruption to the entire model of manpower hiring, which is there. How do you see that going forward?
In terms of cost perspective?
Cost perspective.
So, as we talked about it at the beginning of our conversation, a lot of investments which we are making will be in talent, right? We'd be hiring differently enabled high-skilled talent. We have been spending a lot on reskilling, and we'll continue to spend.
Now let's move on from AI to coffee. Tata Starbucks' ambitious India expansion plans may have entered the slow lane. The company had one set target of one new store every 72 hours, but the actual pace currently stands at one new outlet in 6 days. So what's really brewing at Starbucks? Anjali Palod with that report.
Starbucks Global CEO Brian Nicole, on his latest visit to India, reaffirmed the coffee chain's commitment towards India. The last time that his predecessor was here, they set an ambitious target to open 1,000 stores by 2028 in India. But if you look at the pace of the expansion since then, this does not live up to the huge expectations that were set. Now, to reach this 1,000 store target, they needed to open one store every 3 days. So let's look at what has happened since then. Tata Starbucks closed FY25 by adding 58 new stores, which was a pace wherein which averages at 14 to 15 stores every quarter, roughly about one in every 6 days. This is already half the pace what they had set out for. Now, if you look at FY26, this pace has further slowed down. In the first quarter of FY26, they added only 6 stores, and in second quarter, 7 stores. Now the tally is at 500 with the opening of the Starbucks Reserve store in Delhi this week. That will take that tally to 500. If we look at 2028 as the target for 1,000 stores, which means they're still looking at opening 500 more stores in the next quarters, which would mean 50 new stores every quarter compared to 6 to 7 that they're doing right now. And if we compare to the 14 to 15 that they were doing in FY25, they will still need to pick this pace up by 3 to 4 times, which makes it seem very unlikely that Tata Starbucks will be able to achieve this. Now, at the same time, if you look at the revenue and loss figures, this is FY25 wherein the revenue grew by 5%, but the losses further widened 65% year on year. And the CFO for Tata Consumer Products said that this was on the back of the expansion plans. Now, we've already seen the pace of expansion slow down, and if the 1,000 store target still remains intact, that would mean a huge pickup on investments in Tata Starbucks from TCPL as well as Starbucks company, the joint venture of which is Tata Starbucks. But this comes on the back of heavy losses being borne by TCPL as well. So it would be interesting to see where the strategy for Tata Starbucks will go from here.
The QSR sector growth is clearly losing steam. Weak demand, muted out-of-home consumption and margin pressures are weighing in on most players even as delivery gains continue and store expansion stays aggressive. Snehi joins in with the full breakdown.
Well, yes, so if you take a look at the performance from the QSR names, the quick service restaurant names in the quarter gone by, in the second quarter, overall mixed show coming in. Let me take you through some numbers. The cumulative QSR growth in quarter two was just 9.9% across the listed companies compared to 12.1% in quarter one. So sequential moderation of growth and moderation of demand is something that we've seen. The underlying demand continued to be weak. There was weak out-of-home consumption, macro softness and GST-led pricing resets that led to some slowdown in the dine-in segment of some of these QSR names. You had names like Domino's, which is Jubilant Foodworks, KFC, which is operated by Devyani and Sapphires both, and Burger King, which is restaurant brand Asia. They witnessed improvement in their delivery mix on a year-on-year basis. However, dine-in continued to be soft. Like-for-like growth remained under pressure across brands except Domino's that saw 9.1% growth compared to Burger King that was up 2.8%. But these are the only two listed names in this space that recorded or registered positive like-for-like growth. Everybody else continued to be in the negative trajectory, which was the case with Devyani and Sapphire because KFC and Pizza Hut both reported negative like-for-like growth except Jubilant. All others saw margin declines as well due to negative operating leverage. But store expansion, that theme continues to be stable across the board. If you take a look at the same store sales growth trend, then you had positive moves for Jubilant and Burger King, but everybody else has done quite badly. And Sapphire's operation of Pizza Hut, that has seen an 8% decline in SSSG in the quarter gone by, and that is also much lower than its average of 1.5%. So, well, that is the case. And overall average was lower by 1.5% in terms of the like-for-like growth. The store count continues to grow ahead. If you talk about valuations then, you have Jubilant in terms of 1 year forward EV to EBITDA valued at 22.4 times. The most expensive is Westlife, and the cheapest in terms of 1 year forward EV to EBITDA is restaurant brand Asia, the operator of Burger King in India. Other than the quarter two updates, the reason why QSR companies have recently been in the news is on the back of South Central Railways. They've requested guidelines for premium branded food outlets at stations. So this would allow names like McDonald's, KFC, Pizza Hut, Baskin-Robbins, Haldiram's and Bikaner Wala. These are the names mentioned in that circular to operate at Indian railway stations. So that's a positive for some of these companies. And other than that, you have a city note which has come recently on the QSR space, wherein they maintain their buy rating on Devyani International with target price cut to 182 from 202 earlier. And for Jubilant, they maintain a buy rating with a target price at 800 from 820 rupees earlier. So the conviction continues, but the target prices have been moderated, keeping in mind what the outlook could look ahead for these QSR names after a relatively softer quarter two. So that's a roundup on why some of the QSR names have been in focus. And yes, these are all the reasons why all eyes have been on the QSR space. Yes, there has been a mild recovery in terms of stock performance, but the underlying fundamentals continue to be weak for most of the companies in the listed space.
Now, moving on to an exclusive. Sources tell ET Now that Zomato will soon share customer data to the restaurants. The food delivery company has also started seeking customer consent for the same. Anjali joins in with more details. Tell us more, Anjali. What does it mean for these food aggregators, and, you know, how much will the customer data be compromised?
Right. In a major breakthrough for restaurants, food aggregator platform Zomato has agreed to share customer information with the restaurants. Now, Zomato has started collecting customer consent for sharing this data with the restaurants. So, on anyone's updated Zomato app, on the first instance of placing an order, you will be asked for your permission of whether you want to share your phone number with the restaurants or not. Now, the National Restaurants Association of India is the association, is the body that was in conversation with Zomato to roll out this feature. They're still discussing with Zomato on how the information can hereon be passed to the restaurant and what is the additional information that they wish to collect. Other than the phone number, name and address are some things that the NRAI wants to collect from the customers. However, Zomato's CEO has clarified in a X post that they will currently be only collecting the phone numbers of consenting customers, and this is a feature that they are rolling out. They've even asked for customer feedback on this. Now, NRAI has also been in talks with Swiggy for a similar feature to be rolled out on that food aggregator platforms as well. Now, for a while, there has been this tussle between the restaurants and food aggregators apps over the sharing of information. Earlier, only the name and the macro level data was being shared with the restaurants, but now they have increasingly been asking for more visibility on the customers, and we're seeing a feature rollout on Zomato in that regard. Now, NRAI says that the objectives for this collection of data is fourfold. One is to track the customer journey better. Second is to strengthen their loyalty benefit programs, to sort of have the visibility on dining as well as online orders to offer loyalty benefits. Third is to understand the customer preferences, and on the basis of that, or the fourth objective is to give customized offers and promotional offers to the customers. So those are the reasons behind restaurants asking for this data. But yes, as of now, Zomato is the platform that is rolling out this feature and asking for customers' consent on whether they want to share their phone number with the restaurants or not.
Shifting focus then, the Enforcement Directorate provisionally attached assets worth 1,452 crore rupees in case linked to Reliance Communications. The Reliance Group has issued a statement on the back of this development and has said that Anil Ambani is not involved with Reliance Communications. My colleague Bhavtosh, who has been tracking the case since the beginning, is here with more updates. Bhavtosh, tell us more.
On Thursday, the Enforcement Directorate attached assets worth 1,400 crore rupees of Anil Ambani Group of Companies. The Enforcement Directorate has said that they have attached assets of Anil Ambani Group of Companies in a money laundering investigation that they started in August. The total assets that they have attached so far is around 9,000 crore rupees. ED has already questioned Anil Ambani once in August, and they have also issued summons to him in a forex violation case. Anil Ambani has not joined the investigation. Reliance Group of Companies headed by Anil Ambani has said that this case revolves around RCom, and RCom is no longer part of Anil Ambani Group of Companies. This happened way back in 2019. They have also said that Anil Ambani is not on the board of directors of this company. But troubles are far from over as far as Anil Ambani is concerned. ED has already questioned him once, and CBI has also filed a charge sheet against him.
Well, now it's time for us to slip into a very short break on Business at 9. You don't go anywhere. We will be right back. Welcome back to Business at 9. I'm Shabani Gharat. Now, India and Israel signed the terms of reference for negotiations for a free trade agreement as Union Minister of Commerce and Industry Piyush Goyal announced that the two countries have decided to enter into negotiations for FTA. He underlined that the two nations have unlimited possibilities and potential to expand economic engagement.
Congratulations to my dear friend, my brother, Minister Neer Barkat, on this very historic occasion. Israel and India have decided to enter into negotiations for a free trade agreement soon after having executed a bilateral investment treaty and collectively the bilateral investment treaty and the free trade agreement will open the doors to greater market access, flow of capital, investments and trade, both in goods and services, remove obstacles to doing business, provide clarity, predictability and stability to our economic engagement. And clearly, Israel and India as two strategic partners with deep-rooted friendship and a mutual respect for each other are destined to bigger achievements and greater friendship.
RBI Governor Sanjay Malhotra attributed the recent rupee slump to tariff feud between India and US. He also expressed optimism on a trade deal between the two nations soon. Listen in.
So the recent depreciation that you have seen is because on the trade side, you have seen that there are some tariffs, some additional penal tariffs, as a result of which expectations have built up that our trade deficit may go down. Now, whether it will happen or not, because a lot of it depends on expectations, and that is one. Exports did come down, as you are aware, in the month of October, so it's to do with current accounts. Similarly, on the capital account, you are seeing that the flows this time round, and that's been the case, right? So somewhat muted as a result of which, but we are quite confident that there will be a good trade deal, hopefully, going forward, and that should relieve whatever pressure has been there on our current account. We have very good buffers of foreign exchange, 690 billion US dollars, and so that's not a matter of concern.
Core sector growth in October remained unchanged on the back of weakness in coal, crude oil and electricity production. This is the weakest performance in 14 months. Anurag Joshi is here with the details.
India's October key industries output has remained unchanged from a year earlier. The index of 8 core industries was unchanged from October 2024. This is according to the data released by the Commerce and Industry Ministry. And this is but the slowest pace for the 8 core industries since August 2024. So the slowest pace in 14 months. Now, if we look at the 8 industries, refinery products index rose 4.6%. Electricity index declined 7.6%. The pace of steel output quickened 6.7%, while coal slowed 8.5%. Crude oil output slowed 1.2%. Natural gas contracted 5%. The pace of cement output rose 5.3%, while fertilizers quickened 7.4%.
In a long-awaited snapshot of America's economy before the government shutdown, the Bureau of Labor Statistics reports that U.S. employers added 119,000 jobs in September, more than double the expected 50,000, a sign of resilience in sectors like healthcare, food services and social assistance. However, the unemployment rate ticked up to 4.4%, its highest since 2021. As the Feds weigh a potential December rate cut, this data underscores a job market cooling but not collapsing. And just as we speak about the US market, let's take a quick look at what US markets are doing. Remember that Nvidia beat Wall Street expectations yet again, posting third quarter revenue of $57 billion and earnings of 1.30 per share, both ahead of estimates. The company also issued a blockbuster forecast projecting $65 billion in Q4 sales, which is far higher than analysts expected. Now, on the back of this, we are seeing a sea of green on Wall Street today. What was earlier a tech-led sell-off has turned into a tech-led rally today. The Nasdaq is up almost 2.45% as we speak, and then the blue chip Dow, which struggled to hold on to gains in yesterday's sessions, surged over 600 points and is trading with gains of about 1.5%. The S&P 500 is also up almost 2%. Volatility also declined considerably today. The CBOE volatility index is down approximately by 16%. Now let's go across to my colleague Snehi Shah for what cues to watch out for tomorrow.
Well, yes, lots of cues to watch out for. Friday means it's the day to watch out for forex reserves, so keep a close eye on that. Other than that, we'll have the HSBC manufacturing PMI numbers out, so keep a very close eye on that back home as well. But globally, a lot of macroeconomic indicators to track as well. So that list includes US. From the US, you have University of Michigan Consumer Sentiment and the S&P Global Manufacturing numbers. The same thing, global manufacturing PMI numbers is something that we'll be seeing from UK, Eurozone and Japan as well. Other than that, from UK, you have retail sales numbers, and from Japan, all eyes are going to be on their inflation, their CPI number that's going to be out as well. In terms of corporate action and board meetings back home, you're going to have the recently listed Grow, which has been under some pressure of late. So Grow is going to be coming out with its quarter 2 earnings, so watch out for this stock as well. Kotak Mahindra Bank board is going to be mulling a stock split, so this announcement is also going to be very key to watch out for. India Shelter Finance board is going to be mulling a fundraising, so keep your eye on this stock as well. And a whole host of stocks like Gabriel India, IRCTC, MRF, Info Edge India, Oil India and Sonata Software will be trading ex-dividend as well, so watch out for all of these stocks. Now shifting focus to the primary market, you'll have one IPO listing, one opening and one closing for subscription. You'll have Capillary Technologies IPO that's going to be listing on the bourses. Sudeep Pharma IPO will be opening and Excelsoft Technologies will be closing for subscription. It's going to be the last day to subscribe to that IPO if you wish to do so. Lastly, in terms of some other events to watch out for, we understand from reports that Prime Minister Modi is going to be attending the G20 summit in Johannesburg from November 21 to 23, so watch out for that. ECB President Christine Lagarde is set to speak at an event, so is Dallas Fed President Lori Logan and BOE Chief Economist Hugh Phil as well. And also New York Fed President, John Williams is also about to speak at an event. So these commentaries on the outlook for the US economy, rate cuts, since there is so much conjecture about that in the December meeting, what is their outlook on that? If any of these cues are there in those speeches, they're going to be important to track. So watch out for all of these cues very closely.
Now from global cues, let's move on to south of India. One of the key takeaways of Karnataka's new startup policy is that the state is looking beyond Bengaluru towards building its next big push in the startup space. In an exclusive chat with ET Now, the state's IT secretary N. Manjula told ET Now that the towns like Mysore, Hubballi and Dharwad were on the government's radar, while sectors like semiconductors and deep tech would stay in focus. Here is a slice of that conversation.
Karnataka is, and more so Bangalore, is a startup capital of the world, we can say. So we have more than 18,000 startups coming from Karnataka. And then this is a startup policy, 2530 is a second version. That means we already had one policy before, and there's a lot of learning which has gone into it. And now the government is strategically focusing beyond Bengaluru. So we have already identified 6 potential clusters, and of which in 2 phases we are taking them up. And then the first phase will be majorly concentrating on Mysore, Hubli Dharwad region and Mangalore region. Apart from that, we'll eventually follow it with Kalburgi, Shimoga and Tumkur regions also, because all of these are potential areas. So the startups, already we have more than 5,000 or 6,000 startups, emanating from these areas. So the focus now is to also push them further by building a similar ecosystem which we have in Bangalore beyond Bangalore areas. So that's why, as you mentioned, the 7-pillared approach, the strategy which we have devised, starting from the nurturing, that is the student entrepreneurship onwards, up to the stage of market access and funding them. That is the approach which we have taken up. So there'll be a lot of incubators, accelerators, centers of excellences, etc., which will be parallelly, built up to support this initiative. So we are confident that the next generation entrepreneurs will be supported through this initiative, 25,000 in the whole state. It's the minimum we are expecting, and then at least 10,000 coming from in the neighborhood of Bangalore.
Absolutely, and very admirable.
That was Karnataka IT Secretary speaking about how they are looking beyond hubs like Bangalore, beyond hubs and cities like Bangalore, towards other areas for growth. Well, with that, it's a wrap on Business at 9. Goodbye.